Welcome to the Buy Box Bandits podcast.
What's up, everyone? Welcome back to the Buy Box Bandits podcast, episode 195. Today, we're joined by repeat guest, actually third-time guest, Chris Potter, who is an 8-figure Amazon seller turned accounting specialist. And as we come up on the year end, this is the perfect time to really dig in on all things bookkeeping, accounting, and different things that can help you manage your Amazon business correctly, right? And if you haven't already checked out Boxem, you can get a 2-week free trial on our website, boxem.com, to manage all your listing, shipping, etc. for your Amazon business too. Our sponsor of today's episode. So good to have you back, Chris. Excited to jam on your story and then bring a lot of value to Amazon sellers looking to do accounting and bookkeeping correctly.
Yeah, really happy to be back. Being here the third time. I don't know how many other people have done that, but I'm definitely glad to be on here again.
And
Sweet.
Chris, you and I can watch Miles squirm over the next half hour as Miles kind of tiptoes through the tax stuff.
Yeah, well, hey, we want to make it very clear. None of this is tax advice. Now, Chris does own an accounting company though, so he, I believe, is has some authority over that and everything. But yeah, Chris, you want to just bring us back to your origin story on Amazon, which is it's a pretty cool. Just kind of, I've heard your background before. Most people haven't that'll be listening to this. You want to bring us back through your background and everything you've done on Amazon, getting up to today's in the current age.
Yeah. I mean, we could literally talk an entire podcast on that, which I think we almost did a couple years ago.
Yeah.
But the general story on that is I started selling in 2005 on eBay, and I ended up going full time in 2008. At that point, I went to selling on Amazon and blew my business up. Went basically bankrupt in 2000, end of 2013, 2014, and then started back up again and ran that business until 2020, exited that business in 2020, and then bought franchise tax offices in 2020. During that whole time span, I pretty much did any business model you can think of on the Amazon platform. I did arbitrage, I did wholesale, private label, drop shipping, but my largest operation as of when we exited in 2020. In 2019, we had over 13 million in sales that year. So it was a pretty big operation. Like I mentioned, in 2020, we shifted to buying the tax offices. So we bought 43 tax offices that are ranging from North Carolina and Virginia. And then in 2022, we started a separate business, which is Taluk Advisors, which caters to helping e-commerce companies with bookkeeping and taxes. And now we've helped over 300 clients last year with taxes, and we have over 100 bookkeeping clients, and so we know taxes and bookkeeping pretty well for e-commerce.
So there's you dropped a lot of buzzwords. So for everyone who doesn't know Chris, he used the word drop shipping a bunch. And I know Miles and I talk about drop shipping in a negative light, but it actually legit. If you want to hear more about that specific kind of entity, go back to I think our first episode with Chris a couple years
September
ago.
2022.
So check out that episode. But
Just don't do drop shipping at this point. I mean,
at this point, no.
It's a model that was great back in 2015, 16, 17, 18, but we're in 2024 now. It's a dead model at this point.
Yeah. But I mean, the reason why we were excited to get you on today's episode is Miles and I make a living on helping people scale Amazon businesses. And with that concept, there's a lot of intricacies when it comes to taxes and bookkeeping, right? The same business that was doing $1,000 a month is not the same business and shouldn't be treated as such as the business doing $150,000 a month. Vastly different, right? And a lot of people start this as a side hustle, but at some point start to make that transition to, quitting their job and actually making this a full-time thing, right? So let's kind of talk to those individuals that are now operating a more serious, more legitimate business, probably full-time, now being December. Where should their thoughts start to be, right? The rush is over of Q4, things are starting to settle down, right? So now we have to start to account for the things and the really awesome things that we did in 2024.
Yeah, the biggest challenge I see with people in that range is they just didn't do a great job on bookkeeping. and that's the same problem we tend to see also with even new sellers. They may have just ran things off of spreadsheets, or they ran things just using a tool like Boxem. They may have just ran it off of that. And in those cases, when they're running off software platforms like that, or running off spreadsheets, they're not typically keeping track of everything to keep track of for bookkeeping purposes for taxes. So right now is the best time that you should be starting to think about, all right, well, I haven't done my bookkeeping the entire year. Now I need to take care of that. That realistically is the biggest issue I tend to see with people going to this time of year.
Yep. And what would you say is the starting point in respect to that? Like, what reports to pull from Amazon? What metrics are we looking for in respect to getting the ball rolling with that stuff?
And just kind of like define bookkeeping, right? Bookkeeping, obviously, kind of everyone knows what it is, but what does it actually mean?
Yeah, so if you've done nothing, you have a few different options. One of them, obviously, you could hire someone like us to take care of it. That's option number one. Option number two is you want to kind of do a DIY approach. And we do have a lot of clients that work with us for taxes, and they do their own bookkeeping and they do a DIY approach. So the various things you'll want to do for the DIY approach is if you are using a tool like Boxum to keep track of your buy costs, keep track of your cost of goods sold, make sure all of your buy costs are actually entered into tools like that. That way, it accurately reports what your cost of goods sold is. Next item you should be doing is you should be verifying that you've checked your inventory at the end of the year. So we typically recommend doing what's called an inventory valuation at the end of December. So that's coming up. That's coming up here within a couple weeks. And realistically, you should be verifying where all of your inventory is at. So that's going through Amazon, verifying that. If you've got a death pile sitting in the corner, you should be coming up with how much you have sitting there. That way you can determine how much you may need to write off for any sort of dead inventory or stuff you've thrown away, that sort of thing. And then next, the biggest thing after that is categorizing all of your expenses. So that would be utilizing something. We have a business tax worksheet that you can download for free, and you can take all of your transactions from your credit cards and bank statements, put into that spreadsheet, and then you can categorize the items based on proper IRS categorization to make sure that everything is set up for taxes. So that's kind of like the three-step system I typically recommend for people at the end of the year. Now, obviously, other people talk about, well, what about receipts? What about all this other stuff I've done throughout the year? And receipts, realistically, you don't necessarily need those for tax purposes. You're mostly keeping those in the background in case you do get audited. Obviously, you should have those receipts if like you're working with your accountant and they're like, well, your expenses don't really make sense here. They may ask for those receipts, but realistically, you don't need to like worry about, you know, taking that whole bag of receipts you've probably stockpiled or all those receipts you have sitting in your inbox and your Gmail and starting to print them out and doing all this crazy stuff that we've seen some people do.
Now, given the people that you've worked with, is there like a specific metric point where people start to shift from the DIY approach of bookkeeping to outsourcing it to someone like you guys or another team?
It's all over the place, honestly. We have some clients that have come to us that are less than $100,000 in revenue that have done it. We also have some that don't even start till they're over $500,000 in sales. This year, we actually came out with a what's called a tax-ready bookkeeping service, which is a stripped-down version of our regular bookkeeping service, and we pretty much designed this for smaller sellers that really don't want to do their stuff on their own. It's about half the cost of what our normal bookkeeping is. And it's good. It's good basically just for taxes. So we specifically came up with that for that kind of that kind of question because we do have some clients that they're kind of in that limbo area where they're like, well, I can't really afford to spend on bookkeeping every month, but I also don't want to take care of everything myself because I don't think I'm going to do it right. So we designed that service for that, and that's kind of an area where I think that most people might want to go to if they decide that doing it themselves doesn't make a whole lot of sense.
Okay, and then so we hear about like, okay, net profit margin and ROI, I'd say are by far like the two most common metrics you hear in respect to that other stuff. And you had a great answer for this last podcast. What are some of those other categories similar to profit, similar to ROI that sellers should be looking at?
What was that? What did you say? Like it was like time invested ROI
No,
or
I know
so,
exactly what it is.
return on
I know it. Yeah. Oh, there we go.
return
That's
on inventory.
return on invested capital. Return on,
That's
Yep.
it. Yep.
Yeah,
take it out of my
ROIC
mouth.
is definitely a big one. Well, let's go back a little bit and talk about the first two numbers you talked about first, which are margins and ROI. Now, I'm guessing what you're mostly referring to here is like when you're on Boxum and you're doing your sourcing and it tells you exactly what your ROI is and it tells you exactly what your margin is. Well, you when you're looking at that app, typically when you're looking at the ROI number, that's kind of like contribution margin is mostly what that is. And if you're unfamiliar with what contribution margin is it's basically taking your revenue number and then deducting anything that's associated with selling that item. So it'd be like your cost of goods sold and that'd be your Amazon fees are the usually top two items that get deducted out of that. Then also obviously storage fees,
Prep
also
fees.
Yeah,
see if you're running that as
shipping.
well.
Yeah.
So if you're doing any sort of marketing, and then when you factor all that out, then that's when you get your contribution margin. And that's a really big number you should be tracking because if you are by the time you get through selling everything, which obviously sometimes never sell for the exact price you're expecting it to, when you get done selling everything throughout the month, generally that number shouldn't be any higher than 85% of sales. So if you're talking about all these expenses, including your cost of goods sold, those other things we just talked about, if it's above 85%, you have a very, very hard time being profitable. So that's an area that I typically recommend taking a look at is that contribution margin number, which also means that when you're figuring out your sourcing, you probably should be a little higher than 15%. If you inverse there, like 85% equals when you're looking at the app, 15%. So that's kind of like the inverse there. So that's the number one thing I would definitely take a look at, especially when you're looking at those two numbers. Next one, like you mentioned, is the return on invested capital. So the return on invested capital is different than ROI because ROI is just looking at that specific item that you're selling, but it doesn't actually take into account when it sells or how long it takes you to sell it. What ROIC does is it basically takes that number and it factors it in with how long you're holding onto your inventory. So what you're doing is you're taking what your profitability is and then dividing that by what your average inventory number is, then coming out with a percentage. And the reason why is this metric's really cool is because when you look at that metric, you can now compare that to other metrics that determine if you're putting your money for investments in the right place. Because now you can compare that percentage to places like, all right, well, what's my interest rates on my credit cards? If my ROIC is, 40% and I'm paying 32% on my credit cards, not a good thing. Or another case would be if you want to compare it to the stock market. If you're not paying anything on credit cards and you're making 40, 50%, you compare it to the stock market where you're making maybe 12%, it's a good investment. So you kind of compare both of those things, and that's kind of a really big number. I'll give you one more really quickly before I'll let you ask me whatever next question you have. And that the other big one that I recommend as well is inventory turns. So your inventory turnover percentage is knowing how quickly you're selling through your inventory. Generally, we typically like to see, especially with people who are in the arbitrage space or even wholesale space, we usually like to see somewhere between 50 to 70% sell-through rate within a given month. What that means is that if you're buying, $10,000 of inventory, you should be selling through somewhere between $5,000 and $7,000 of that inventory within a given month. Now, there's obviously a lot of variables here, like if you're buying a lot of very high ROI sell-through items, and then it's okay to kind of be a lower number. But I would say on average, most of our sellers who are very good at managing their inventory and are profitable are usually between that 50 and 70% range. If you're higher than that, then whew, you're amazing. If you're much lower than that, you have to make sure that you're selling your inventory at a higher ROI number and a higher contribution margin number to kind of offset you having to hold that inventory for a long period of time.
Yeah, that sell-through rate at 50 to 70% per month, what does that end up being on a daily basis?
So that would be on a daily basis. That would be, let's
Like
see here. So 50% would effectively be that you've sold through half of your inventory that you bought.
Yeah,
So effectively, if you're looking at it from that
per
perspective, a
day.
month, that would mean it would take you about 45 days to sell through your inventory.
Boom. Okay. Oh, yeah, that's what I mean. So per day, the sell-through rate would be like 2% then,
couple
probably, or something
percent,
like that.
yeah.
Exactly. Yeah, because the booksellers are
Dude,
great at stuff
yeah,
like this. Yes,
exactly what
I
triggered it
remember it
because I
from back
think
in the
like
day. Yeah.
the
Yeah,
going number was like
2% per day would
1%.
be about 60% sell through.
Boom. Okay, cool. Sweet. So like that, and that's because sometimes, people will ask like, okay, how much should I sell per day? I never really had a good number to tell them outside of like what I kind of remembered from like the bookseller days, for example, like way back in the day. There, which is cool. Now I was gonna bring up inventory turns too. That's a phenomenal metric. That's actually really accessible in Seller Central too.
Yeah,
As well. I believe it's in inventory and then inventory planning on
like
Seller
the
Central.
performance dashboard or something like
Yeah, so
that.
you guys can
Yeah,
go, if you're listening to this, you can go look at that, immediately here and take a look at that. And then,
but it gives an
days in
actual
inventory
number.
as low as possible. And then turns, if you're pumping, it'll be like 9 to 12. If you're like
Right.
hardcore going FBM and stuff, I believe is the metric right there.
Yeah, it'll give you that metric, but keep in mind that that's only looking at raw numbers. So what you typically recommend doing is when you're looking at your financials is you want to do it on a financial basis because it can be a very big different thing. Because if you're churning stuff over that's like very low dollar amount stuff, but then the stuff that's like very high dollar amount stuff is taking a lot longer to sell, then it could look very, very good on Seller Central, but the reality is you're not churning through your inventory fast enough to be able to ensure you have enough working capital moving forward. So yes, it is a good number to have to look at in there as kind of a relative gauge. But then you can also look in if you're actually running, if you're doing regular bookkeeping, you can look at your balance sheet, see what your average inventory is, and just divide that by your profitability. That's a pretty easy number to look at.
Boom. Okay.
So we live in like a weird kind of convoluted business space where, especially early on, we have so many things going on, right? We have inventory at a prep center, we have inventory in FC transfer, we have inventory selling, we have inventory inbound from several different OA sites. So I feel like for OA sellers in their first 6 to 8 months, it can be kind of convoluted to really have a pinpoint, like an ideology in terms of, is my business actually growing? And if so, how much and how profitable am I? Because you have a credit card statement, you have obviously cash on hand, you have all this inventory, you have fees, you have this and that. So like, how do you kind of work with some of your newer sellers to really understand if and how much your business is actually growing early on?
It's a pretty convoluted question on top of that. So, to answer that question, I would say that if you're looking at your finances, there's a few things you have to look at. You have to look at your profit and loss to see how you're doing, which Boxman and apps like that do a pretty good job as far as telling what your profitability is. The area that usually is a blind spot for most new sellers is the cash flow side of things, which can be looked at on the balance sheet.
Ooh,
Now,
okay.
when you're
Yeah,
looking
let's
at the
dig in on
balance
that. That's very, very, and it depends FBA, FBM too. This is a very good game right here.
Yep. So when you're looking at your balance sheet, there's effectively three areas on the balance sheet. There's your assets, there's your liabilities, then there's your equity. To kind of like I can go to a lot of bookkeeping type stuff, but the reality is that from a seller standpoint, you absolutely have to have more assets and liabilities, otherwise you're screwed. And so what is an asset? So an asset would be how much money do you have sitting in Amazon, how much inventory do you have, and how much cash do you have in the bank. Those are the three major things for Amazon sellers. Obviously, the big one that a lot of sellers like totally forget about is all that money like sitting in reserve balances at Amazon. So if you add kind of all those things up, and then you take your liabilities, which is your credit card debt and any sort of loans that you're taking out, you add all those together and you basically do a very quick math, assets minus liabilities. It should be significantly larger than than zero. If it's not, then you have a really big problem on your hands. So that's kind of like the biggest area I would say that you should be looking at your balance sheet. And a lot of people just don't even have any clues. What they'll do is they'll just rack money up on their credit cards, wait for the credit card bill to come due, and then they just say, okay, well, I think I have enough money. They pay it off. And then 3 months later, they realize, oh crap, this game doesn't work anymore because I'm not selling my inventory fast enough. And I've got way too much money on my credit cards. Then they start paying interest on their credit cards. It becomes this whole like kind of death spiral at that.
Yeah.
Yeah, so
And
ideally, as little of that as possible, and you put it through the Capital One Spark, you get the 2% cash back, for example, on that too. And then just in terms of like, obviously, like I'd say personally, as little leverage as possible, if any, right? You write some really good content out there about just like kind of the math behind debt and stuff like that. So on like the loan side of things, for someone who's looking to aggressively scale, they understand the risks associated, right? How do you actually break down, whether a loan makes sense and what are the different metrics for it? Because I've read some of your content about stuff like this. It's pretty interesting.
Man, that was a good question.
yeah, I think the key here is you have a couple things to look at. So we talked about ROIC earlier, right? And I gave that example as far as like interest rates being X amount versus your ROIC. Well, your ROIC needs to be significantly higher than whatever the interest rate is for it to honestly make sense. Now, if you're getting a 14, 15, 16% interest rate, which is very common right now for any sort of Amazon loans or effectively lines of credit, that's kind of the range you're getting them in. And your ROIC needs to be closer to probably like 80% to kind of like make that make sense, which we have a lot of sellers to do that. We have sellers that push 140%. So it's definitely doable. So that's kind of one area you need to take a look at. The next one you need to look at is when we talked about that assets versus liabilities, right? A very quick and dirty number you can look at is how much inventory do you have, and then compare that to how much debt you have. All right. That's a very big number you can look at. We call a debt to inventory ratio is what that
Mhm.
is. And what you're doing is you're looking to see, all right, well, I have $100,000 of inventory. How much do I have on debt? Well, if my debt is about $60,000, then my debt to inventory ratio is basically six to one or 6 to 100, however you want to say it. And in that case, it's good. Pretty much what you don't want to have is you don't want to have more debt than you have inventory. The moment you have more debt than you have inventory, you have a real issue. So when you're looking at it from that perspective, when you're thinking about, all right, should I take on more debt? Is you need to look at that ratio to begin with. If that ratio is less than one, then there's no way possible you should be taking on more debt. If it's like we just talked about, where it's like point six, which would be $60,000 of debt versus $100,000 of inventory, that's probably okay to take on more debt. But when you start pushing one or even higher, then you're really in trouble, and you
So it's
should
a
not take.
matter of obviously where your business stands. But would you also consider what sorts of products you are going to be likely buying with that loan? Because most sellers have one of those loans, just like looking at them at the on the dashboard, right? And so, like, how do they evaluate whether they pull the trigger or not? Right? Is it a math equation in terms of like, all right, I know I'm going to buy this product that's going to generate approximately this much. I know the loan's going to cost this much. Is there a certain threshold where if I'm only making a couple of percentage points after the loan, whether it's worth it or not, whether it makes sense or not?
I think another area you have to look at too is what are the terms of the actual loan as well. Because there's a lot of term loans where it's like 6 months, and then they break it up within a 6 month time frame, and then at the end of 6 months, either you've paid back most of it, or now you have to refinance or do something with it. So usually we recommend, especially for those style loans that you're talking about, where they're term loans where you're not really sure what you're going to redo, you should not like really incorporate that into your regular buying patterns. Where that absolutely makes sense is during Christmas, is a huge area where it makes a lot of sense, or if you're going to a very heavy seasonal period for whatever industry that you're in. And so if you sell a lot of like summer stuff and you go really heavy into summer items or back to school, then you take on that debt, you buy it just for back to school stuff, but then you make sure it's paid back as soon as back to school is over with. Same thing with Christmas. Take it out when it makes sense to do that. Or another option would be is if you're going into the wholesale space, and let's say you're working with a wholesale supplier, and they say, "Hey, I've got this discontinued item that we're not going to get any more of," and you're able to buy out that whole supply, and you need to get cash all up front to do that. Well, okay, well, earmark that money specifically for that item you're purchasing. Just understand that when the item sells, you need to make sure the loan is paid back and you're not like repurposing that money into other products. Because when you do it that way, then it starts becoming into your normal patterns of what you're buying. And then you just totally forget about it and you don't really realize, oh crap, this is due in X amount of days. And again, it's kind of that whole spiral where now you're having to figure out, am I going to refinance this, or am I going to come up with the money to make sure this is paid
So you
off?
would almost recommend to only use it for one turn, pay it off, and then keep it moving.
Yeah, that's what I would recommend doing, at least for those style loans that have determined payback periods that are pretty tight. Now, if it's like a 12-month period, then you can be a little more judicious about that. You can say, okay, well, it's a 12-month period, then maybe I can get a few turns out of it. It
Right.
may, if my turnover ratio is, let's say, 50%, then that means I'm actually turning my inventory 6 times throughout a year. So maybe to be safe with it, maybe I say, all right, well, once I've done turns over 4 times, then I'm done with this money, and you don't replenish it as part of that. And again, we're talking about a very safe mechanism here.
Right, of
There are
course.
a lot of sellers that don't take this advice whatsoever, and they just go full full balls out, and they just keep spending it. And that's when you start hearing stories about crap. I'm hoping I'm going to get a refinance, which most of the time happens. Most of the time, you get some sort of refinancing offer. But the one time you do not get that refinancing offer is when you're absolutely screwed.
Yeah, and it also like the reason why stuff like this, if you're gonna do it, it has to be when you have a lot of expertise because how you're gonna sell the inventory and even how you're sourcing it has a huge effect too. Retail arbitrage to FBM, quickest. OA to FBM, second quickest, right? OA to FBA, a little bit more scalable, slower, right? Wholesale to FBA, significantly more scalable, significantly longer lead time. For example, lead time being, the difference between from when you order something to when it actually gets sent in or you receive it. And then if you're doing wholesale to FBM, quicker than wholesale to FBA, for example. And that's why like it's really important to have expertise around this stuff prior to doing it if you're going to, which in many cases I think a lot of people shouldn't. right? So if you're, we're sitting here on December 16th, right? A lot of people are knee deep in the FBM trenches right now. We hope you are listening to this right now too, as well. You're, going, put the item in the poly bag, put the label in the poly bag, put the item in the poly bag, I want a lot of that for all y'all, right? But what can you do like before the end of the year? Like what you'd be putting together right now, to be as prepared as possible tax season wise?
To kind of be prepared for tax season, specifically for that. I mean, we talked about bookkeeping, I think is the biggest area that you should be ready. That I think is a major one. Realistically, as long as you're taking care of that, that's the key. Now, there are some tax related things. Maybe that's kind of more the question you're asking for.
Yeah, in respect to like checklists, for example, right? So it's like, okay, have an eye on your inventory valuation, have an eye on, you know what I mean, like create a balance sheet, for example, that type of stuff.
Yeah, I mean, we talked about the inventory valuation at the end of the year. We talked about categorizing all of your transactions to ensure that you've done that. Ensure that you've gone through and got your 1099 Ks for any sort of platforms that you'd be selling on. Let's keep in mind that if you sold less than $5,000 on a platform, which some people sell like a Mercari and somebody's really
Oh, don't
small.
don't say that, because then we're gonna get the messages. What if I sell 5,001? What if
Yeah,
I
you
sold
get it, I
5,000?
think.
Well,
Yeah.
if you're under 5,000, theoretically, you won't get a 1099K this year. That's the limit this year. It's been changed compared to prior years. Theoretically, you won't get a 1099 if you sell on those, but you're still required to actually report those sales. So you have to pull the sales from those platforms and make sure that you have all of the information from those platforms as well. So make sure you have your 1099Ks, make sure you have all of the settlement platforms, and your accountant will love you and is assuming you have those prepared for them. Those are some items I would definitely recommend doing. Now, from a tax perspective, there's certainly just a few things you potentially can do before the end of the year here. If you are actually reporting your inventory on a cash basis, which if this is your first year, you have an option to either do cash or accrual method, and we can talk a half hour about that, but we're not going to. But
Yeah, that's very,
pretty much
very
what
detailed stuff. I know,
yeah,
I
pretty
know.
much
Yeah.
what that means is that if you buy inventory, the moment you buy it, it's immediately expensed. And so if you're doing that methodology, if you're using that, you can buy a bunch of inventory before December 31st and knock down all of your income. And so realistically, if you're looking at your P&L and you're like, crap, well, I'm actually like $40,000 profitable for the year. Well, you theoretically could go buy $40,000 of inventory and totally wipe out all of that income and then pay $0 in taxes on all of that income throughout the year.
But then you got more
So
the next year.
Yeah, and it's
yeah, I
like
would say I'm more
very.
than
This is where y'all got to make sure you consider working with a professional. You know what I mean? This is where
yep.
like it gets very, very sketchy. I
Yep.
feel like.
And of course, keep in mind everything I'm talking about here is theoretical in nature. I'm not giving tax advice. I'm not giving any specific advice for your situation. I would strongly recommend talking with your accountant to determine what the right situation is for you. But that's a strategy that a lot of sellers use, and what you're effectively doing is you're just kicking the can down the road in this scenario. But again, the whole goal here is to keep kicking the can down as far as you possibly can, so that way you can keep reinvesting in inventory. The theory is that if you're doing that, if you're not paying taxes on your income, then you can keep reinvesting into the business, which allows you to generate more income than if the IRS took, 30% of that cash away and you couldn't use that money to generate more income. So inventory is a big one for anyone that's using cash basis for inventory. Anything else, like let's say, for example, you need to buy some supplies before the end of the year, that's a big one. You can also prepay expenses. So if you're looking for Boxum, and I'm guessing you guys have like an annual subscription you guys could do. If they pay for the annual subscription before the end of the year, they can write it off this year as well. Same thing for us. We have our tax launch right now. If you pay for your taxes before the end of the year, even though we're doing the taxes next year, you can write them off this year. So those are just kind of some very easy things you can do at the end of the year. There's a lot of other things you can talk to your accountant about too, but those are pretty easy ones. They're actionable just kind of within these last couple weeks here.
So you're saying not to buy a Lambo with the first 100K you see? Is that a fair assessment?
Yeah, I mean, I've definitely had more than multiple 100Ks, and I don't own a Lambo, so
Got okay.
no, I
Got
would not.
Makes sense. Makes sense.
Fair enough. You
As
heard it here first.
yeah.
What
Hey, you got it.
for people that are like looking to learn more about this stuff, maybe on spare time, or if you're me while you're running, what kind of podcasts, books, things can they be educating themselves about just taxes in general?
Exactly what I was going to ask. Yes, perfect.
Yeah,
Great.
obviously you can follow me on Twitter. I post a lot
Yep.
of and that's just at Chris Potter 361 is my handle on Twitter. There's actually a book that, especially for people that have larger businesses, there's a book called Tax Free Wealth. It's by Tom Wheelwright, I believe, is the person that wrote it. And they go through all these various things that you can do to try and eliminate your taxes as much as possible. Some of them are pretty, I would say, gray area, if you will. But the key thing here is that if you open your mind as far as the things you potentially can do, so that when you have the conversations with your tax professional, you can even say, "Hey, is this applicable to me?" And a lot of times, like if you don't ask those questions, your accountant won't necessarily know whether it makes sense for you to do whatever it is you're attempting to do. But if you know as a seller what is available, you can ask if it makes sense. And then they can say, well, yeah, it actually does make sense for your scenario because not everyone knows every intricate thing about you or your business or even
Yeah.
what your planning is in the future. So those are questions you can ask as well.
I mean, for the listeners that have made it this far, you're likely pretty serious about this. So I commend you there. But like as you zoom out, right, taxes are a good problem, right? It means you've done something right. It means you're doing the right things. You're putting the right actions in motion. Another way to kind of start to reduce some of these things is, talking about potentially converting to a S corp, right? Can you, a very general perspective, educate the viewers in terms of like the difference of an LLC and an S corp and kind of that denomination?
Yeah, most sellers when they first start out are going to be an S or going to be an LLC or a sole proprietor. That's pretty much what everyone starts out with. Then you have to make a decision on when you should start to move over to an S corp. The difference here is that anytime that you are a sole proprietor or an LLC, you're paying something called a self-employment tax, which is 15.3% of whatever income that you're making. You're paying on every single dollar that you're paying out, which is on top of your regular income. What that's doing is it's effectively replacing your Social Security and Medicare that you would normally be paying if you just had a regular W-2 job. So that's what it's designed to do, and it covers the employer side and the employee side. Now, what an S corp does is it cuts out your need to have to pay that tax on a portion of your income. So what you typically will do is you will set yourself a salary, which now means that you're paying Social Security and Medicare on yourself. But then any money you make above whatever your salary is, you no longer have to pay the Social Security and Medicare, and you also don't have to pay that 15.3% uh, the self-employment tax. So that allows you to save a ton of money. And realistically, the break-even point that we typically recommend for people to start looking into moving over to an S corp is about $50,000 in profit. Because once you do that, there are some other things you have to keep in mind. Is now you have to pay yourself a salary, which means you now have to have a payroll service. Also, there's a separate tax return that has to be done as well, which costs more money to pay to have someone do a tax return. Also, you need to keep a balance sheet because that's part of a tax return to do that. So theoretically, you should have full-scale bookkeeping as well, which can be a little bit of additional cost. So when you kind of factor in these various costs, $50,000 profit is about the number where you really start to see money being made. And obviously, if you're making 100,000 or more, it's an absolute no-brainer that you're going to save some money in taxes without a doubt.
So not necessarily specifically related to taxes, but I think another area where you excel at is just like generally managing a team and having employees and kind of like continuing to make all those employees kind of moving in the right direction. For the people that are, hiring their first VAs or managing a team of VAs, what kind of advice would you give them to kind of maximize that team?
Yeah, it's a great question. To kind of give you a scale as far as what we're working with here. I mean, in the past when I was running the drop shipping business, I had over 100 people working for us in the Philippines. So we had a very, very big team over in the Philippines. Right now, with our physical standalone locations, we have about, I think, anywhere between 60 and 80 employees that are mostly seasonal. And then on this side of the business, we actually have, I think we're up to about 20 people on this particular business for ecom. And so obviously it's a lot of people to manage. So if I'm a person that's hiring my first person, or even as a smaller case where maybe it's a few people, the biggest thing that I can say is you have to give proper expectations to the person up front as far as what to expect. and then make sure that you create any sort of training procedures or what we call SOP, standard operating procedures. So that way they fully understand what they're doing, and then constant follow-up to make sure that they're actually doing what you ask them to do. And if they're not, to give them that constructive criticism so that way they know what to do better. Because most of the time, most people want to do a good job. I mean, there are obviously some idiots that could care less, but the majority of people actually want to do a good job. So you really just need to make sure you give that feedback. And the best bosses in the world, if you ask anyone to say, are they good bosses? Are they good leaders? It's because they've set the right expectations. They've been told what to expect, and they've gotten the appropriate follow-up, and not only just criticism. Obviously, you're also giving them some praise for things they're doing well. And if you combine all of that, and even if you think about if you've been working for the man, if you're a W-2 person yourself, I'm guessing your best bosses, if you think about it, that's the exact same thing that they've done as well. And so you just translate that to anyone that you hire, even if it is someone in the Philippines.
It's one of the best VA answers I've heard.
Yeah, seriously. Yeah, that people got to make sure you follow Chris on all socials, and where can they do that, Chris?
You can find me on Twitter at Chris Potter 361.
Boom. So yeah, you guys check out that. It'll be linked in the description. Follow Chris. Posts a lot of good graphics and just kind of good ways to think about business, and really kind of definitely like one of a kind in respect to stuff you see on Amazon, Twitter, and everything too. So I thought the third podcast was the best one yet. So thanks a lot for coming on, man.
No problem, man.
Thanks,
Cool.
man.
Yeah, and then if you guys are interested, I believe Chris, we have a special offer too for the Buy Box Bandits listeners, right?
Yeah. We're actually doing our tax launch right now. We're in the middle of it. And what that means is that if you sign up for our tax services over up until January 9th, then you get $250 off of your tax services. And realistically, we handle pretty much any sort of taxes you need. We can help S corps, we can help LLCs, we can also do your personal taxes if you want as well. We do all of that. And like I said, if you do it before January 9th, then you receive $250 off, which is the only discount we offer the entire year. So even if you come to us on January 10th, sorry, there is no discount for anyone after that date.
Boom.
If you decide you want to go with that, we've actually set up a special page on our website that not only gives you access to that $250 discount, but there's also some other cool freebies we put on there as well. We have our ebook that lists out the seven biggest mistakes that people do with their e-commerce businesses. So we've got that on there. We have a business tax worksheet that allows you to keep track of those expenses like we talked about earlier today. There's also a link to my Twitter account as well. And then we have some other things to talk about bookkeeping. We've got all sorts of articles to help you out as well. And you can find that at talloakadvisors.com/buyboxbandits.
Boom.
Pretty
Sounds so clean, right? That's the only Buy Box Bandits I think we've ever had. Sounds so clean right there. Well, appreciate you coming on, Chris, and thanks everyone for listening. And we'll see you guys in the next episode.